Welcome back to the Funding Blueprint, the show where we decode what it really takes to fund, build, and scale a startup from the ground up. Whether you're an early stage founder, a first-time builder, or just startup curious, we bring you candid conversations with the people shaping the future of innovation. I'm your host, Cece Nahaman, and today we're diving into the nuanced realities of what makes or breaks a startup, beyond the pitch deck and the term sheet. And to help us do that, we're joined by Jacob Conger, principal at Headline, where he invests in early stage infrastructure software, works closely with breakout companies like Honeycomb, LucidLink, dBeaver, and more. Jacob's journey is as dynamic as the startups he backs. From pro gamer and actor to two-time failed founder to investor at firms like B Capital Group and Lindsay Goldberg, he's now at the forefront of early stage investing, helping shape the trajectory of ambitious companies and the founders behind them. In today's conversation, we're unpacking some of the less talked about dynamics that drive startup success, how to rethink founder market fit, what real founder-investor alignment looks like, how startups can scale through product cycles, and why talent, clarity, and decision velocity matter more than ever. If you're building an early stage tech or leading a team through rapid growth, this one's for you. Let's get into it. Jacob, welcome to the show.
Thank you, Cecilia. It's nice to be here.
Awesome. We're so excited to have you, and let's just jump right into it. Let's start with something that you've been vocal about, which is founder market fit. A lot of investors still lean on that airport test, the idea that they'd want to be stuck in an airport with the founder for hours, but you've said that's not necessarily the right filter. So what does real founder market fit look like to you? What filter should we be using nowadays? And what are some signals you tell a founder, or that tell you a founder has the right to win in a particular space?
Yeah, I love this topic because I do think it changes quite a bit. But if you're traditionally trained in VC, or if you're learning how to be a VC, or you're a founder who's trying to raise money, I think these are all really important topics. Historically, it's been the concepts of bet on the founder or founder market fit is everything, but those are really just buzzwords. And so you bring up a really interesting topic. I think the airport test is very flawed. I think some of the most intense, high conviction founders whom I know would fail the airport test pretty much 9 times out of 10. Founder market fit isn't really about charisma sometimes. It really isn't about vibe sometimes. It's to be honest with you, more about obsession. It's about earned insight. And candidly, like to go change the world, to go build something that changes how a market evolves or how consumers or buyers behave, you kind of have to be a little different. And for that reason, a little bit off the beaten path or a little bit nuanced. And those folks aren't necessarily the ones you want to eat at the airport restaurant with. So I think there's a lot of nuance to this. But the key question that really centers around is what gives a founder a right to solve a specific problem, right? Yeah. Has this founder lived a specific pain, or are they energized by this idea, this concept, this resolution to a problem, even on the worst days? Life will throw so many different wrenches, as we all know, but can this person continue to get up day in and day out and be ultra motivated to solve this problem? So I'd say that's really where it starts, is there a unique insight, a unique aspect to this founder, and what gives them the right to solve this problem? I'd say the best examples that I've seen are just often sound a bit irrational, right? It's like there might be such tremendous personal frustration that turns into a product obsession, or perhaps a career of like a pattern recognition that has crystallized over time again and again and again into a vision before a market was even ready. But it's those types of things that create that personal gravity toward a specific problem. And without that, I think it's tough. It's tough to see founders move mountains and go the distance, whether it's 5 years, 10 years, 15 years, to go build generational companies.
Yeah, 1,000%. And I feel like that founder fit can tie closely to another piece that you often emphasize, which is founder-investor alignment. A lot of early stage founders are so focused on getting a yes that they overlook whether it's the right yes. So, my next question is, what should founders actually be evaluating when choosing investors beyond just the check size or the prestige?
Yeah, I love this question because I do think the answer is unfortunately it depends, but I definitely have advice for founders. In the startup ecosystem, I'll just reiterate, you're looking to go change the world. You're looking
Yeah.
to go change the way people behave, the way that people interact with software or hardware sometimes. But and at the end of the day, what that means is it takes not just 2, 3, 4 years. It may take 7, 10, 15, 20 years. And so the first lens through which I really encourage founders to think about this is, assuming they do want to work on this problem for that long, is can I see myself working on this problem with this investor for that long? And there's a short-term honeymoon phase for sure, but at the end of the day, is this something that I can truly build alongside someone with their support and partnership and tutelage? And I think that's often overlooked in the short-term hype
Yeah.
cycles or the short-term nascency of many of these fundraising rounds. I don't love the term marriage. I think it's overused. I think even marriages break down, and I actually think it's less serious than a marriage. And what I mean by that is I think of it as a long-term relationship. By definition, long-term relationships either end up in marriage, so end up in this IPO or this M&A or this amazing liquidity event for everyone, or they end up in a breakup, right? And there's really not much in between. And for that reason, it's binary. That's the same with startups, right? Startups can scale very quickly. They can go push, push, push and burn a lot of capital, but it's either you make it or you don't, and there's not a middle ground there. So that's the first, I think, key criterion I would use is just that evaluation of time, that evaluation of partnership. But outside of that, I'd say the best investors aren't just capital providers. They're the ones who show up, who fly out when things go sideways, who don't bail on you when customer acquisition cost is through the roof or when you burn a little more than you expect to or team starts turning over. And so for that reason, I'd say think of your investors as problem solvers. If your
Mhm.
challenge is hiring, for example, let's just say that's what you're focused on at the time, then your investor should be helping you source and close talent or helping you think about ways to better add to top of funnel on the hiring side or better close higher quality leads in the bottom of funnel. Or if you're navigating through a tough pivot per se on the product side, they should be in the weeds helping you pressure test your options. And
Yeah.
so they will not have all the answers. And I won't speak for every investor in the whole VC ecosystem, but they're very rarely going to know your business as well as you do. But they do need to add leverage. And so that's a really critical piece of evaluation. I'd say that if you're thinking about a framework or thinking about screening, it's that long-term partnership for sure, but it's also finding leverage. They help add leverage to the way that you scale and operate. And then there's a few more. I'd say decision-making styles really important. Do they expect to be consulted or do they just want to be informed of your progress? Uh, Communication cadence. Do they want to go dark? Do they want to stay close? And in personal involvement, do they want to be in the thick of it, perhaps a little too much? Do they want to be involved in helping you shape the operations of the business? And is that something that you want as well? So all those things lead to this key question, which is, do they see the world the same way that you do?
Mhm.
And will you be able to do it together? And so there's a whole lot more to it, but I'd say those are the big key questions. And I think a lot of other folks bring in brand and bring in, to your point, prestige. And I think those are incredibly helpful as it pertains to developing what I would call power and developing this like gravity, this density in the VC ecosystem. And if you can check those boxes, fantastic. I'd say there's a few more bullet points I'd certainly optimize for.
Yeah, absolutely. Once a startup gets that initial traction, it can be easy to fall into the trap of thinking the hardest part is over. But you've said that one great launch won't carry you, especially when it comes to product. So, can you talk to us and talk us through what it looks like to truly scale through multiple product cycles? And what are some structural shifts founders need to keep iterating effectively post launch?
This is such a critical concept in
Yeah.
startup development. And for first time founders, this is a bit more difficult to grasp. I'd say for second, third time founders, certainly a more straightforward concept. But if I boil it down, too many founders think the first product release is the business,
Mm-hmm.
right? And candidly, it's probably not. It's really what I would think of as the entry point. The startups that win big, right, are the ones who keep cycling, who ship, who learn, who repeat, and then every new wave of growth is followed by a new wave of product improvement or even product development. And I actually bear with me here. Like there's a metaphor that I thought of just the other day in talking to a founder about this. I saw the most recent Mission Impossible movie 2 weekends ago, and there's a scene in which Tom Cruise, I won't ruin it, but a scene in which Tom Cruise is ascending from the depths of the ocean, swimming, trying to swim from the very bottom to the very top. And I think that's incredibly metaphoric in how you should think about startups. When a startup launches, you launch from the ocean floor, right? And you take one very, very big stroke to kick yourself upward. And that's your first product release.
Yeah.
The problem is one big stroke when you're 1,000 meters below the surface only gets you a short of the way to the surface. And what it then requires is another big stroke and another big kick. And if you don't continue to push the envelope to build more product, to build effectively a whole new startup every product cycle, then you're not actually kicking more. You're not stroking upward, and you're probably going to get stuck sinking, not actually floating to the top. So what I mean by that, and I know it's a tacky metaphor, is you have to keep pushing through, especially if you're burning capital. And the companies that do go, like I said, change the world are the ones that have tremendous product velocity. And that requires unhooking from your first vision. And it requires like building systems that empower ongoing creativity, right? And that's engineering, that's marketing, and
Yeah.
all the different business units that support that DNA for every product release to ultimately compound value. For founders, what I would encourage is, if I try to simplify it here a bit, is there's a level of forward thinking that needs to be fairly unparalleled. The strategy needs to continue to look ahead past the current product suite, and this product roadmap, if you will, that term that I think is overused, needs to go beyond the next quarter. It needs to be looking around corners and seeing the next iteration of the business. And you just can't become complacent just because something's working today. Your mindset
Yeah.
has to be about staying one iteration, if not two iterations, ahead of what your customer will need next. Those are the best businesses that build products, that build platforms, that have multi-product and multi-feature use cases that deliver tons and tons of value over time and keep customers around.
Definitely. Kind of shifting a little bit here. Team building is one of those areas where a lot of founders don't realize they're aiming a little too low until it's a little too late. You've worked with companies that raised the talent bar as they scaled, not after. So, what does a great early stage team actually look like in your experience? And what are some practical ways founders can level up their hiring without over hiring or bringing in the wrong fit too soon?
Yeah, this is great. This is the problem that every single startup faces:
Yeah.
hiring. Hiring. How do I keep scaling the right way? To be honest, it doesn't have to be perfect on day one, right? And what I can say is most startups are nowhere near perfect. And what I would say a team composition looks like, or a team quality looks like on day one. That said, if you fast forward to say, day, I'm trying to think, what, 1, 2, 3 years. If you look at day 500 or day 1,000, it definitely cannot stay average. It has to be something that continues to move. And what I mean by that is the bar that founders that you set for the quality of your team has to continue to go up as your business scales revenue. But a great early stage team, some attributes I certainly look for and recommend and to would encourage founders to think through: executes really quickly, but with a little bit of constant oversight. And what I mean by that is always iterating, always testing, always trying new things. Without perfect data, you don't need 100% of the data, but maybe 60, 70%, and making those decisions and those guesses and testing those hypotheses quickly with a little bit of oversight to make sure that you're creating a feedback loop, right? That's the first. The second would be teams that punch above their weight, right? So you're maybe hiring young folks, maybe hiring under-credentialed folks, or those that just don't have the resume that you typically find at some of the bigger large tech companies. That's okay. You're looking for hungry people, and there's thousands of those in the ecosystem who can punch above their title, above their weight, and very much like you're thinking about capital markets, you want to buy low on fantastically smart people. The third, I'd say, attribute that I look for is having strong generalists who can grow within a company. At the very early stage, there is really no method to the madness. You're going to be wearing a lot of hats. You're going to be doing sales, marketing, product development, eng work. You're going to go biz dev on the weekends. Like, there's just many different things that early stage teams look to accomplish. And once you get to that Series A stage, it'll feel more regimented and structured. But up until then, it's folks who can do a lot of things, but have very high slopes and very, very, very fast motors. And as a result of that, can then develop into these leads or these generals that sit around the table with founders over time. What that also means, I'd say, is hiring people who are elastic, who aren't afraid to go from 0 to 1, and then can also hand things off. So there's a lot that goes into that, but early stages is I'd say more about adaptability than resume polish. You asked a question about leveling up hiring. This is, if I had the perfect answer for you, I'd probably write a book. I unfortunately don't have it. Every startup does it differently. There are a couple of things that come to mind. First, I'd say ask folks around the table. So I'm speaking to founders here. Ask your advisors, ask your mentors, ask other founders to help you define what good looks like, to help you define what an A plus player looks like, and A minus as well, right? Understanding what those look like and then constantly can benchmark to is really important. And I don't think many founders, to be candid, know what A plus looks like or even A minus looks like at the early stage. And that can be often very clouded in bias or clouded in judgment. But that's a first step. I'd say the second is creating a feedback loop on hiring outcomes. So who succeeded at the business, or who have I seen succeed in his or her role, and why? And if you can institutionalize those feedback loops, you can then formalize those learnings and understand like how I translate hiring to outcomes. And without creating that A to B, that line of sight, it's difficult to see where things go well and why. Where I've also seen folks struggle, and I would certainly recommend against this, is don't over title too early. It's easy to say, hey, we have an 8-person team, a 12-person team, so everyone here is a vice president, everyone here is a CFO, everyone here is an executive title. You want to hire for a trajectory, right? As I mentioned earlier, that elasticity, and that means perhaps hiring younger or less titled so that folks can grow and scale, versus just hiring off of a resume. In these scrappy startup ecosystems, folks who have already accomplished quite a bit are actually quite rarely the correct hire for early stage companies, because they're used to having large teams. They're used to having folks who they can delegate tasks to, and used to having resources and a budget. Early on, folks who are used to that usually don't deal with ambiguity and no budget quite effectively. So those are my tidbits and pieces of advice, but I think if I bubble it all up to my brain's just like screaming out the computer screen here to say, just look for resilience, look for speed, and look for humility. And I think if you can capture those things, you'll find a lot of A plus talent with elasticity and high trajectory. And the final piece would be to try to avoid mishiring by hiring B minus or B plus folks. And the reason for this is not because they aren't talented, it's because you will create significant cultural debt within your company if you're aligning B players with A players and compensating B players the same as A players. You'll pay for it pretty tremendously later, and it's going to be difficult to get out of that way.
Yeah, that was great advice. A lot of insight packed into that one. Speaking of speed, one thing that doesn't get talked about enough in startup execution is something called decision velocity, which you mentioned a little bit back. Founders often obsess over strategy, but it's really speed and clarity that can keep the company going. So what does high velocity decision making look like inside the startups that you work with?
Wow, you're hitting all the right questions here. I should pull my founders into this meeting. High velocity. Look, startups live and die by speed. At least I
Yeah.
think they do. Where I've seen startups struggle is just with indecision. Like
Hmm.
indecision is a silent killer, right? If you can't get out of your own way for different reasons, you just won't move quick enough. And so, what does high velocity decision making look like? I'd say it's a couple things. Like back to that point I made earlier, is making decisions with less data, right? You
Yeah.
have to develop a culture and a framework for not waiting until 100% data and information to be informed. You have to make decisions quickly with 50, 60, 70% of the information required. And if there's not a culture and a framework for that, it's going to be tough, right? So just start thinking through how you do those things, especially if you're more less of a risk taker, because there's a
Hmm.
lot of translation to taking risk that involves decisions without that information.
Yeah.
Uh, like I've also seen startups struggle when they don't have final decision makers, right? When
Hmm.
you have two or three or four co-founders who all have CEO, CTO, COO type of roles, who've all been friendly from the get-go, it's very difficult to translate that into a framework of chain of command. And
Hmm.
when there is not one person, but two or three that have to sign off on a key decision or even a minor one, you can often get in your own way. And so I think creating a world and a structure where there's a single final decision maker within each domain is really important. And I'd say back to those feedback loops, creating very tight feedback loops to correct courses fast. Once you have new information, once you have key learnings, once you can understand the impact of your decision operationally or executionally, if you get that signal that, hey, maybe we're moving in the wrong direction, you want to be able to correct course really quickly. So
Hmm.
build in what I would call short feedback loops, not long. You want small wins, celebrate those, but you want to know small losses very quickly.
Yeah.
Where I think teams can get stuck, if I'm just racking my brain, too many cooks in the kitchen. I think at that point I'll just continue to hammer home. No clear escalation paths. So when there are issues, problems, key decisions that have to be made, what's the right path to get those to the right decision makers? When you don't predefine those, it's difficult to just be productive, I'd say more generally. And then finally, co-founders, like I said, with bilateral decision making, vetoes, no tiebreakers. You want to build the governance internally and the decision making internally to avoid those types of things. If
Hmm.
everything is a group decision, nothing moves, right? You want to define ownership early, decide who makes the call, and trust them. And if you are high velocity, it doesn't necessarily mean sloppy, but you will see that sometimes. It means more though deliberate frameworks. And when you move fast, you have momentum. You cannot have consensus paralysis. You need to build a structure that enables you to avoid that.
Yeah. Kind of like bouncing off of that, tied to that, is something we've seen time and time again is that lack of role clarity. I know you said it's key to have that one decision maker, but in the early days, everyone wears every hat, and that's chaos that can become costly and fast. So, in addition to having that key decision maker, what are some frameworks or tools that you've seen help teams define roles as they grow?
Yeah, good question. Frameworks that teams can use to help them define and grow. Yeah, I think this is the right question. I think there's a lot out there. You can read
Yeah.
many of the books that I've written on this and behavioral psychology on it. Where I've seen things work is starting from the top and then building frameworks below that include chains of command and include decision paths. And those ultimately then create accountability, right? And so what I would say is you start with like a directly responsible individual for a certain role or task, right?
Hmm.
That individual is responsible for driving and then coming to a decision. That person may not be doing the work or collecting the information, but ultimately is responsible for a decision. And so when you have key projects, key roles, key initiatives, uh, just key new work streams, things you're looking to accomplish, you need to assign a directly responsible individual, and those are often called DRIs. And then define milestones for those specific work streams in which you do need to acknowledge and have a moment of responsibility for that DRI. And so along the way, there's a milestone of coming to a conclusion, or B key takeaway, or C key inflection point, right? And so we define those as moments of responsibility, or moments in which the DRI truly needs to step in and make a decision. And if you, back to that feedback loop piece, if you have fewer of those moments of responsibility, there's less line of sight, and it's tough to attribute specific signal to a specific operational decision. So you want to create tighter feedback loops, more frequent moments of responsibility, shorter time frames on when you can actually acknowledge key directions or key decisions on workflows. And then for all of that, you want weekly scorecards, or you want weekly ways to measure success. Mm-hmm. I'm not the biggest believer in OKRs, or like having very strict KPIs, but having a scorecard that can help you understand and define success on every one of these things helps you get from point A to point B to point C with each of those individual folks who are directly responsible individuals, and can measure success very quickly. But all this, what it does is it creates clarity, right? It creates clarity to free up the more important things, candidly, which is like creative energy and reducing internal politics, because it comes back to speed, right? Without it, teams spiral into this like disjointed passive execution, and it's really, really important to avoid those things. Like once you do create these clearly defined lanes, people can move fast, they can surface blockers, and take full ownership of outcomes.
Yeah, absolutely. To kind of wrap things up here, you've had such a unique journey from founder to investor with some pivots in between. So for a founder listening who's still figuring out if they've got the right fit or the right team or the momentum that they need, what do you think is one underrated trait that you believe early stage builders should really double down on, especially when the path ahead is still feeling uncertain?
Oh gosh, there's so many answers to this question. I feel it's hard for me to pick one.
You can pick a few.
There's two to come to mind. I'd say the first is embracing being uncomfortable. Mm-hmm. And so that's not exactly one attribute, but I guess it's a pretty wide comfort zone as a way to think about it, or at least an ability to stay outside of the comfort zone. The reason why is because challenges will be very different every single day. Like once you learn how to solve problem A, then you get problem B, and then you get problem C, and then you get problem D. And it's very rare that you'll come back to the same problem if you're smart and you're keen and you're a sponge and you're learning, because then you'll avoid the same problem moving forward. And so like always being able to find comfort in that discomfort is something that I've seen founders really excel with.
Yeah.
And that translates to just so much success and so much open-mindedness and ability to listen and low ego, but at the same time high IQ and high EQ. And so I just think that's really important more generally. The second that comes to mind, Cecilia, is like a relentless self-awareness. Right? Mm-hmm. The best founders I know are constantly asking, what am I not seeing? Yeah. Where am I the bottleneck? What do I need to unlearn to get to the next level, right? It's the CEOs who perhaps don't ever view themselves as the bottleneck, who are struggling to scale. Mm-hmm. But it's not about perfection, it's about adaptability. And so through that lens, I'd say the greatest early stage builders I know, they seek brutal feedback early on. They take ownership of team dynamics. What else? They invest in coaching, sometimes therapy, sometimes structured reflection. It's not necessary, but they know they're human, right? And so that relentless self-awareness is great. That introspection, if you will, is what I've seen really great founders do incredibly well.
Yeah, absolutely. Well, thank you so much for sharing. But unfortunately, that is a wrap on today's episode of The Funding Blueprint. A huge thank you to you, Jacob, for joining us and sharing so many sharp, actionable insights from the front lines of early stage investing. From rethinking founder market fit and challenging the airport test, to understanding the real dynamics of founder-investor alignment, Jacob gave us a masterclass in what it actually takes to build a high-growth startup, from decision velocity and role clarity to raising the talent bar and navigating through product cycles. Whether you're a first-time founder or scaling your second company, there's something in here that'll help you move smarter and faster for sure. If you enjoyed today's conversation, make sure to check out Jacob's work at Headline, where he's backing the next wave of technical infrastructure companies and founder-led innovation. And of course, don't forget to subscribe to the Funding Blueprint wherever you listen, and share this episode with a founder friend who needs to hear it. We'll be back with next episode with another bold builder reshaping the startup world. But until then, keep building with intention. Thank you so much again, Jacob, and thank you so much for listening.
Thanks so much for having me.